Thanks, Will. It's nice to be here. I can tell you that the journey with Charlie and GuruFocus has been a very long time in development. We first ran into Charlie when he was breaking down 13Fs, and we were trying to do the same thing. And that was probably like 2007 or 2008, somewhere thereabouts. So it's kind of fun to see how the GuruFocus platform has expanded so much. I will tell you that professionally, running a $2 billion firm, GuruFocus is probably the one place that everybody in the firm goes to every single day. And I share that because if you're on this talk, you probably already drink the Kool-Aid. But I will tell you, there is something new to learn on the GuruFocus platform every day. So eat it up, lots of great information. As far as my talk goes today, I'd like to share with y'all a little bit of some of the things that we are seeing, some of the conversations that we are having with clients, and intermixed, we'll try and show some ways that we utilize GuruFocus to either inform our decisions or just to serve up good ideas and then be able to verify them. So that said, at the end, I think it'll probably take 30 minutes to run through my prepared stuff and plenty of time for questions. I don't think, let's see, there we go. I don't think it's a big surprise to anyone that we live in a pretty complicated world. But I will tell you that so much of this is a psychological battle. And if I had college to do all over again, I probably would have started off with a degree in behavioral finance, the how and the why people make financial decisions. And if you look at the news, quote unquote, that is being served up to us, in the last couple of months, you've got yahoos like Jim Cramer that are telling us the second coming of the 1987 crash is upon us and run for the doors. And of course, the Wall Street Journal and the New York Times are also seizing upon that to try and prey on our nerves. Because what we really need to understand is the major news services are not there to give us news. They are there to sell us advertising. And the bloodier the story, the more sensationalistic the story, the more eyeballs tune in. The problem is that is generally a really bad foundation for making quality investment decisions. So, number one, understand the complicated world we live in. Don't let yourself get pulled into the news cycle of the day. We have six TVs in our office. Five out of the six are currently turned off and normally are. One is in the back and it's on mute. And I will tell you that after about 8 o'clock in the morning, we don't listen to any of the news of the day just because it's not newsworthy. It's a rehashing of the same garbage all throughout the day. Furthermore, we just can't have a discussion any day now without tariffs being front and center. And I'm going to be the first one to tell you, I don't know what the outcome is going to be. Obviously, it has changed a lot. And every day that Donald Trump is at the helm, it's going to change a fair amount depending on what his mood is and who he is trying to negotiate with. That said, I can see multiple outcomes. It's just the timing of what they will be. So, short term, depending on what the outcome is of actual tariffs that are imposed, that is going to increase the cost of doing business for most Americans. However, longer term, it may incentivize a lot of folks, companies from around the world to set up shop in the United States. That in turn will boost US GDP and will also boost jobs. So it is not a linear, good or bad decision. There are multiple shades of gray that most likely will come out of the tariff discussion. I'd also encourage you just not to get pulled into the political discussion. Nothing good is going to come from arguing that a Democrat is better for the economy or a Republican is better for the economy. That is not the way the economy works. And no matter what any presidential figure might say, they don't run the economy. So if you are running a business and your candidate does not win, capitalism does not just take the next 4 years off. Capitalism keeps trudging forward regardless of who our leader is. And what I want you to take away is that capitalism succeeds in spite of our elected leaders, not because of them. We also know that, our elected leaders, we would never allow them near our family's checkbook or budget just because they make really bad decisions. But if you look at the performance of the stock market over Republican and Democratic cycles, you recognize that the long-term trajectory is very positive. And a lot of people, getting back to the behavioral finance side of things, if you align yourself, affiliate strongly with the Democrats, then you are probably underinvesting in a Trump administration. Conversely, if you affiliate Republican, you were probably underinvested in the Biden administration. And I can just tell you the psychological studies and the mathematical performance of people's accounts reflect this. And I can just tell you that's a bad decision. Regardless of who is the president, you need to continue to be a logical investor. We also are faced with lots of conversations about the dollar. The dollar is going to go to zero. The dollar is devaluing. All sorts of interesting conversations. And the point I want everybody to take is running your own portfolio, running your own household is different than running the federal government, especially in the United States, because the US federal government has, number one, the largest economy backing itself, and we have the world's reserve currency, which means we can play some games with how we devalue the currency over time. We borrow lots of money and we pay it back with devalued dollars. What I want you to understand, though, is as long as the US economy is growing faster than our debt and interest obligations, theoretically, we can play that game indefinitely, which is a very hard dynamic because no banker is going to lend money to us as individuals indefinitely without having to pay it back. So here's a good trivia question for everybody regarding devaluation. Which country had the best performing stock market in 2024? Some of you may be smart enough or quick enough with the Google machine to know that it was Argentina. So in 2024, the Argentinian stock market was up 161%. But once you factor in inflation and currency devaluation, it basically was break even. So that shows us two things. Number one, be careful of stock markets that show this phenomenal return, because currency adjusted, it may have done absolutely nothing. But if you are investing in a country that consistently devalues its currency, one of the best ways of maintaining your purchasing power is in the stock market, in productive businesses, in businesses that are multinational, that are getting paid in currencies from all around the world. Well, if that's true, then what does cash actually get us? Well, understand cash is a local phenomenon. It needs to be thought of that way. We pay our short-term bills in cash. If I live in the United States, I am going to pay my bills in green dollar bills for the next 30 days, maybe 6 months, maybe a year. All those short-term obligations are going to be settled up in dollars. So you've got to have some allocation to your local currency. Beyond that, though, we know that currency will be devalued, especially in a fiat currency society. That typically brings with it some sort of Saturday morning infomercial that says, oh my God, you should never own the dollar. The dollar's being devalued. You should own gold or precious metals or Bitcoin. And I'm going to tell you, I agree that over the long term, gold and Bitcoin, gold more so, because I can understand it a little bit better, will do better than the dollar over long time frames. The problem is that walking into the grocery store with a big nugget of gold is not exactly the most logical or efficient thing to do. And not many places take Bitcoin as payment. So again, getting back to how we settle up, we do so with green dollar bills if we live in the United States. Furthermore, we don't think the conversation is gold or Bitcoin versus the dollar. That is usually the way it's framed by people who are trying to sell us precious metals or cryptocurrency of some sort. Instead, you need to add in a well-diversified, high-performing multinational company. If gold and Bitcoin are on the table in terms of investment decisions, then a multinational also needs to be there too. And of course, with any of these, they work, but only if you give them enough time frame. We'll talk about that a little bit later as to what a proper time frame looks like. But the next time somebody tries to pitch you gold or Bitcoin versus the dollar, just understand that there are more options on the table than just gold and Bitcoin. So what happens if the US does default? Well, I don't know if it will. Most likely the dollar will not be the reserve currency at some point. I just don't know if that's going to be in my lifetime or not. And it's such a hard decision. I'm not sure I've got to make it today. But just as we talk about these things, we ask just, theoretical kind of questions. If the US defaults, does that mean Coca-Cola no longer sells soda water? Do people no longer go to Walmart to buy low price stuff? And will people stop using Google search or YouTube? Well, at the end of the day, you may be able to time an awful lot of things, but trying to time the default of the US is one very interesting thing. But if I'm trying to hedge against all those bad things happening, the answer for us always comes back to owning high quality, multinational, wide moat businesses. So when we talk about the decline of the dollar, and especially the current news cycle we're in, there's lots of discussion about abandoning the dollar as the world's reserve currency. And I will tell you, I've been doing this long enough to know that every 10 to 15 years, there's a group of countries that are proposing how we need to abandon the dollar. Well, obviously, they have their reasons. And usually it is players like China or Russia or the other BRIC countries, Brazil, Russia, India. They want their own currency. They don't want to be tied to the dollar. The problem is there's not enough stability to truly be a world reserve currency. And for all the people that talk about how the dollar is no longer being used, the data is just not supporting that. So in the chart on the left, you can see this is as of April of this year. It hasn't changed that much, but foreign demand for treasuries is actually up quite a bit. And for foreign demand for US equity holdings, it is also up through the first quarter. So the narrative that everybody is abandoning the dollar does not appear to be the case. The narrative that everybody is dumping their treasuries and no longer holding US stocks is also not the case. And when we look at that, we recognize that the US represents about 25% of world GDP on a daily basis, but the dollar represents 60% of world GDP. So, yes, some people are angry at the dollar. Yes, there are some policies that will cause volatility in the dollar. The dollar is there to pay our short-term bills. The dollar is not something for us to hold over the next 10 or 15 years. That is an unproductive asset. Instead, when we talk to our clients and we think about investing, we recognize, again, getting back to the behavioral finance side of things, success is about discipline and patience. So in Texas, we have these two iconic businesses. One is called HEB. It is probably the most large scale, high profit grocery store in the entire United States. And it's based in Texas. We also have a business called Buc-ee's, and it's now expanded beyond Texas, but it started in Texas and is known iconically throughout the state. They are both private and they are both non-tradable for that reason. And as a result, we always use these when we're trying to frame a discussion about how we should think about investing. Because again, a stock is a proxy for an underlying business. If we can't trade a business, then what do we talk about? If I can't trade HEB, I'm going to sit down with the produce manager and I'm going to ask him how he is sourcing produce and how he keeps his store clean and his challenges associated with hiring good quality people so that he can get people in the store, get them the products they need, make a good profit margin on it, and then get them on out the door. Because ultimately, earnings are what drives the value of a business. The stock market offers liquidity on a daily basis. It does not measure the success of a business beyond a blip on a daily basis. So again, if we all think about these as private businesses, non-tradable, we'll ask much better questions about the fundamental strength of why we invest in one business versus another. That these days is bringing up another set of questions. Well, why not private equity or credit? I got a phone call and there's a can't miss deal on it. In the sales pitch, I kid you not, a couple of our clients have gotten this. We're offering a low risk investment that produces between 8 and 15% return. So I just want you to think about that for a second. 8 to 15% low risk. So when we start thinking about that, we recognize the 10-year treasury yield somewhere between 4.2 and 4.4%. The S&P 500 produces returns of about 10% a year. So what kind of magic does the private equity or credit market have to have in order to be able to deliver this performance of 8 to 15%? We're either doubling the US Treasury or we're doing 50% better than the equity market. Well, when we break it down, it typically comes down to one of three perspectives. We either increase our duration, so if it's a fixed income item, we have stretched out our maturity, which increases risk. We've decreased our credit quality. Maybe we're junk debt, maybe we're completely in default, but it's certainly not the credit quality of a treasury bill. Or we add in leverage, not just a little bit of leverage, a truckload of leverage, or maybe we bind all three of those together. As a result, private credit and private equity is not magic. It has not defied the laws of physics or finance and come up with some new magical solution to make all sorts of money. It is financial engineering. And whenever you put that three things together, duration, decline in credit quality, and adding in leverage, you really increase the opportunity for some bad things to happen. And it's private, meaning it's non-tradable. In this particular case, that non-tradable function means that we should get a premium over stock market or publicly traded assets. So this is some research from Verdad Capital, Dan Rasmussen's operation. And his analysis, and we've seen other forms of analysis that backs this up, is the financial engineering. A lot of people will say, sure, okay, fine, I'm going to have some more leverage, but does it work? Well, the results are starting to show that it's not. And I think that's why Wall Street is done passing these projects back and forth to each other. And now they're trying to push them off on this unsuspecting average public investor. So therefore, when somebody calls trying to sell you public equity or private equity or private credit, put both hands on your wallet. Because as this chart shows, the returns just are not there in terms of, number one, they're having to borrow at higher interest rates, so they have a lot more leverage, but yet the returns are not nearly as good as public market assets are. That tells me that I want to stay away from the private asset space right now. So when we start talking about this, we now have talked a lot about things not to do and things that concern us. Some of you may be familiar with Hendrik Bessembinder. He is a professor at Arizona State University, and he's done a lot of great research into the statistics of what really drives the market. So in analyzing the market over multiple decades, he analyzed more than 64,000 companies, which gives a broad enough sampling population to really understand what's going on. And he realized very few produce returns in excess of a treasury bill. In fact, it's only 2.4% produced returns in excess of a treasury bill. 55% failed to produce a return as good as a treasury bill, which is amazing. Here we are taking all this risk, and yet more than half don't even perform with a treasury. 2.4% are the ones that produce that excess return and deliver all of the returns of the stock market. But if you can't handle short-term volatility, you're not going to get it. You've got to be a long-term investor. Also, as you are thinking through this, I hear lots of academics and lots of people that sell mutual funds talk about, oh, you need to be diversified. Well, to coin, the popular word that was used by Peter Lynch, is it diversification you're seeking or diversification? More is not better. And as a result, if only 2.4% of all stocks that are out there are responsible for all the returns of the market, those are the stocks that I want to be looking for so I can hold them over long time frames. I don't want to own 500 stocks. I don't want to own 1,000 or 2,000 stocks. I only want to find those that have the best odds of performing very, very well. And as a result, I'm probably willing to have high concentration in my portfolio. As we know, both Buffett and Munger benefited hugely from concentration early on. So often this is met with the discussion of, well, the market's expensive right now. I don't know how much I want to be in a concentrated portfolio. That's true, but understand that valuations follow earnings. So the value of a business will follow its earnings. As you can see here, as you go over to the right-hand side of this chart, margins continue to go up. And if you go back to the year 2000 and 1990, profit margins on the S&P 500 were actually below 4%. So as time goes by, profit margins continue to get better. Higher profit margins drive earnings. More earnings yield higher valuations. Furthermore, it's not just the Mag 7 that's delivering it. It's really interesting to look at this chart and see how strong the Mag 7 was in 2020, 2021, and how they did in 23 and 24. But now all of a sudden you're seeing a slowdown in the Mag 7 and a dramatic improvement in the overall S&P 500. So that tells me that there's probably more opportunities for everybody to find highly profitable businesses beyond just the Mag 7. That said, the market is still at a higher valuation, but if you own wide moat businesses that truly have a sustained competitive advantage that produce 15% returns on equity and capital, two things can happen. Your timing can be off on when you make that position. You can pay too much. And if you are patient, it will still be a good investment decision. And that leads us to some very wise words from Warren Buffett in the 1987 Berkshire Shareholders Letter. Buffett cited the importance of one metric, return on equity, and we'll talk about how that is calculated in a minute. But in this, Buffett went back and analyzed by hand, this was before computers, from 1977 to 86, only 25 out of 1,000 companies met two tests of economic excellence, an average return on equity of 20% plus and no year below 15%. As a quick side note, Hendrik Bessenbinder found that all of the returns of the market, the positive returns, came from 2.4% of the companies. Well, 25 divided by 1,000 is 2.5%. 2.5% are the number of companies Buffett found. And then he found out those business superstars, they were stock market superstars. During that decade, 24 out of 25 outperformed the S&P 500. It is amazing how Buffett had stumbled upon this research, not stumbled, he did the math, the same type of math that Hendrik Bessenbinder backed into. It is a mathematical analysis that all of us can use GuruFocus for to back into a similar pond to fish in terms of finding very high quality businesses. So average return on equity of 20% for a decade, no year below 15%. That is a really good pond to fish in. However, some of you who already know the formula recognize that return on equity can be boosted by introducing debt into the capital structure. While that boosts return, it also enhances the risk profile of any given company. So we compare return on equity to return on capital. The difference between the two allows us to identify the amount of return that is associated with the introduction of debt in the capital structure. And as we think about return on capital, we are reminded of a comment from Charlie Munger. If you hold an asset long enough, your rate of return will approximate your return on capital. So again, looking for businesses that consistently produce high returns on capital being favored over return on equity because sometimes businesses get a little carried away with debt. That allows you to own wide moat businesses with high returns. Our timing can be off. We can pay too much, but if we're patient, we can still get a good return. So let's look at how those are calculated. So return on equity looks at the entire business, the entire capital structure. And it basically looks at net income divided by shareholders' equity. And it's a managerial ratio. It tells Buffett and everybody else how well management is taking the net profits of a business and redeploying them back into the capital structure to continue to grow the net worth of the company. So that is a really effective starting point. However, we know that debt can be used, so we want to figure out where does that factor in. So we will then run return on capital or return on invested capital. One of the really nice things about GuruFocus, you can go into the 30 years worth of financials. You can also go into the interactive charts. And if you click on return on equity or return on capital, capital employed, it will give you the formula for how that is all calculated. So you don't have to remember all of it, especially if you are newer. Return on invested capital, it starts to account for the debt that is inserted into the capital structure with a business. So instead of using net income, GuruFocus uses EBIT, so earnings before interest and taxes, divided by the total shareholders' equity, but then we add back in long-term debt into the denominator. And again, the difference between return on equity and return on capital is the amount of return produced by using debt. We can then further enhance that by looking at return on capital employed. This adds in things like leases or possibly a pension obligation because they are obligations. They are long-term obligations. May not be debt, quote unquote, but it is still a long-term liability of a company. So that is calculated by EBIT divided by total shareholders' equity plus all of the long-term liabilities. And then lastly, we will sit there and especially in this day and age of some of the super capital light businesses of Microsoft and Facebook, Adobe having to put money back into their capital structures, we want to know, okay, this is a change for you guys. We want to see what that looks like. We will use something like return on incrementally invested capital to help us understand how that capital is being deployed and what the incremental returns are off of it. So that looks at the incremental operating profit divided by the incrementally invested capital. So let me give you a couple of examples and just help you walk through how we look at this. So the first one is AutoZone. You know, most of us are familiar with AutoZone if you live in the US, but it benefits heavily from logistics, cost advantages, and intangible assets. But the interesting thing is it doesn't have a positive return on equity calculation because its book value is negative. Its book value is negative because the company buys back so many of the shares. When it buys back shares, it reduces its book value. So return on equity is a nonsensical number when looking at AutoZone. Well, we need to be able to look at other metrics that can help us evaluate AutoZone. So we start by looking at return on invested capital. You can see it's at 29 right now. The mean and the median have been above 28%. So really strong numbers. You can start to see why people like AutoZone quite a bit. If we go to return on capital employed, which again is going to bring in leases and pension obligations and things like that, we get an even better return there. So we're currently at 47%, and you can see that the mean and the median are both above 49%. So, I mean, that is a phenomenal number. If Buffett's looking for returns above 15 or 20%, then we should see that 49 is really impressive. And then we start looking at the incrementally invested capital. So here's the 1 year, and you'll notice the big dip in 2016. There was a decline in operating profit compared to the prior year. It's a 1 year deal. Obviously, on any business, you're going to see some volatility 1 year versus the next. But for the most part, we are producing very strong returns. You can see that the mean is 23, the median has been 36. So even though we've got that 1 year where it dipped off so far, kind of just want to go and read a little bit more about what happened in 2016, 2017 to produce that so that I can figure out what is that part of the narrative I need to understand. When we go to a 3-year return on incrementally invested capital, the mean and the median are both above 40%. The lowest has been 15%. So that's a pretty good number and starts to tell us over a slightly longer time frame, things continue to look really good. And then we do the same exercise over a 5-year time frame. Our mean is 34, our median is 28, and the lowest has been 17.5. So again, you can see all these reasons as to why people like AutoZone. So for us, if you'll go back in early 2021, everybody was talking about how Elon Musk and Tesla was going to take over the world. And in doing so, nobody was ever going to drive an internal combustion engine car again. Everyone was going to be flying around in jets and spacecraft or electric Teslas. And as a result, nobody would ever go to AutoZone to keep their cars running. We used that pessimism to initiate our position for around $1,100 a share in January of 2021. Well, today it's almost at $4,000 a share, and we've been able to take advantage of also the market re-evaluating AutoZone, now trades for 25 times earnings. But it's been a really good investment. It also goes to show that if you're patient and you have done your homework on the front end, you can set alerts to trigger you and say, hey, you need to go look at AutoZone. It's dropped down to where you said you wanted to buy it. Alphabet is also another really good one. So here, return on equity, you can see very, very strong. You also kind of have that one-off decline due to the Tax Cuts and Jobs Act, but that was not operational. So again, being able to read back on what created that decline helps us to understand how Google or Alphabet has done. Lots of strong moat aspects. So network effects, switching costs, and tangible assets. We just need to figure out what's going to happen with search. When we go to return on capital, 32%, and the mean and the median are both above 27. So pretty phenomenal. Even the lowest has been 17.79. Return on capital employed. So again, similar type situation, the mean 22, the median 18.8, the lowest 16.4. So again, very good numbers, the kind that should get everybody's attention. And then we start talking about the incrementally invested capital. And this is really where you can really see the choppiness of a business like Google, as well as the capital allocation decisions on behalf of management. you can see that management is making some pretty big dollar allocations year in and year out that's causing this big fluctuation in where the numbers pan out. So return on incrementally invested capital currently are good right now, but they could be much lower depending on how Google is rolling out capital. When we do the same exercise over a 3-year time frame, we're currently at 24, but our mean and our median are also 24. And then we come to a 5-year number. Our current 5-year return on incrementally invested capital is 36, but our mean and median are both above 20. So all that ought to get our attention. All of these return figures were done using the interactive charts with GuruFocus, something I always enjoy doing, as well as this chart here was done with the interactive charts too. You can see that back in 2018, we took a position in Google at about 25 times earnings, $54 a share. It's about 200 bucks today. And again, if you pay a higher price for a really great business, it still has the opportunity to grow into it. So setting alerts, we will go into Guru, and there's the opportunity for you to set alerts on different valuations. So a lot of times people go, well, what's your price alert? I actually think that's a really ignorant statement. We don't do price alerts, we do valuation alerts. So we will go through every different valuation that we think is important. And we kind of want to figure out when a business is trading in the 75th percentile of high valuations or more, I want to be alerted. I want to know, hey, you might want to consider what is driving this and do you need to sell? Conversely, if it's at the 25th percentile of valuation or lower, is this an opportunity to possibly buy? So you can set all those alerts. It'll email you directly as to what the alert was that you set and help you to better manage a portfolio. Lastly, investing for the long term. Again, getting back to that behavioral finance part. The stock market is a liquidity mechanism. It is not a logical valuation. If you're going to own stocks, don't day trade. That's just an opportunity to give money to the casino or the broker dealer. If you're going to own stocks, own them for long term. The highest opportunity for good outcomes comes from being a long-term investor. It also allows you to lower your tax burden by deferring taxes for a long time frame. And then lastly, Buffett used to say, if you've got a 160 IQ, give back 30 points, you don't need them. I never really understood that until I'd been in my career quite some time. Success in investing is about being patient and disciplined. It is not about being a rock star. So again, Buffett has given us the formula in the 1987 Berkshire Hathaway annual report. It's something that you can use. You can use the all-in-one screener from Guru to try and find those companies and start tracking them, as well as many of the other screeners that are there, such as the Buffett Munger screener or the predictable consistent screener. So those are my prepared remarks. Will, back to you. Ready to answer any questions. All right, you're gonna have to help me tell me where those are. All right, this is when you learn that Dave does not do technology well. Why don't you read a couple questions to me while I look for this? It's a really interesting question. I would say the answer is I don't know. Um, I would say that we have started to see a bifurcation in the market as a whole, more so just because like 46% of small cap companies don't produce positive earnings. So if you are just trying to make it as simple as possible and you're following companies that are profitable, well, you want as long a track record as you can possibly have in order to be able to evaluate it. If you can't have good insight into what has happened in the past, it makes it really difficult to think about what's going to happen in the future. So that said, if 46% of small caps currently don't produce profits, I'm not sure that I want to go there, number one. And number two, I'm not sure that it is deserving of a premium. So you've seen a lot more large companies become kind of winner take all in their markets. Makes it very hard for a small cap company to compete against a Microsoft or a Google or an Adobe or things of that nature. So small cap premium is probably not something that I would chase after. Okay. Yes, I would consider investing in cyclicals. They're just a whole lot harder because again, so think about this. You've got a cyclical stock and you think it's at the right point. So not only do you have to time the in, you have to time the out. You got to pay taxes during that time frame. In comparison, you've got to factor in opportunity cost. So if you had the opportunity to invest in Microsoft or Visa or Microsoft or a lot of these other companies that have been able to compound consistently for very long time frames, the cyclical is not only a matter of timing when to buy, but when to sell, deduct out your tax burden. It's also then, were you better off just owning that wide moat business that is predictable and consistent? I am either not smart enough to figure out the cyclical asset, or I've gotten to the point to where owning the wide moat business that I can leave alone for a very long time. Number one, I under most circumstances, I only need to know when to buy it and then hold it for an extremely long time frame. And I get better deferral of taxes, which also enhances my net rate of return derived from that asset. Demodoran. So the question is, how much do I factor in as well as the Motoran's analysis of the corporate life cycle? There's some really good work that has been done on that, and I've got to believe that, especially historically, if you go back and study uh, strong returns decade by decade by decade. The leaders, the top 10 companies that drive the value of any given decade, they're almost guaranteed to change over that next decade or successive decades. Some of them will hang in there longer than others, but you typically have some pretty good turnover. So it is there and it is real, and you have to stay on top of whether or not a business is getting better or worse to try and determine, is this something I want to continue holding? So I do think that it is real, but we are starting to see businesses that are able to grow and maintain their growth as a mega cap longer than historically had been true. So, as much as I respect Demodoran's work, there's at least a body of thought that maybe things are changing going forward, especially on these large platforms that allow software to scale up worldwide without the need for expensive warehouses or distribution systems. When you've got something like Facebook in which all the contributors are providing you the inventory and it basically costs nothing more than some software programmers, that to me is something that can scale almost infinitely as long as it retains eyeballs and users. Ooh, you know what? We own a few shares of Palantir for clients that requested it. We have never placed that trade. So let me answer the first part of the question. How do we value a pre-profit company? I will tell you, I have this talk with myself about once every 2 to 3 years. I look in the mirror and I say, "Hi, my name's Dave, and I'm a serial offender for investing in private businesses." Because some friend of mine says, "Hey, I've got this private business. It's got all these great things going for it." And what I've realized with pre-profit businesses, that are private kind of startup type deals, they always take longer to get going, they always take more money than anticipated, and you're really exposed to like key man risk. If Satya Nadella leaves Microsoft, I am very confident that somebody will be able to step into his shoes. It's not game over for Microsoft. But with a very small business, you've got way more key man risk than most people realize. And again, the discussion, the seduction, the allure of private equity, which a private business is, it just sounds like, oh, anybody can do it. It's private and we're going to make all this money. It is super hard. And a lot of times we've taken board positions because we got sucked in. We owned a bank in Austin, Texas for about 14 years. And I took a board position because we had some client money in it. um, it became a second full-time job for me because the competitive landscape was really tough. We did have the death of the CFO, who was really a key person. And we've just seen that play out multiple times with private businesses. So when I look at those, again, I have to have that look in the mirror and just say, Dave, you are a reformed private investor. Don't do it. The public markets are so much easier. Switching over to how do we value a business like Palantir? It's with a big question mark. I love Alex Karp. He is a really cool, interesting person. I don't know how you value that business and do so with anything other than a scientific wild ass guess, because the outcomes are so extreme. And although we recently had really phenomenal earnings, the first time that that asset stumbles, I mean, it would not surprise me to have a 50% haircut on them. And that's when you're modeling these things on these things that are so extremely priced, you just have to understand that tomorrow you could come in and it could be 50% less. So if that's true and you still want to do it, I think that really comes to a matter of position sizing. You want to position that much smaller. We don't have a problem being concentrated investors. We don't have a problem owning 5, maybe 7%, even 10% in positions that we really have high degree of confidence that do offer that predictable, consistent pattern of profitability. But if it was something like Palantir, I would size it pretty small. If it hits, that's great. But if it goes to zero or cuts in 50%, you have not put your entire portfolio at risk. Yeah. So when I was in graduate school, I was taught a lot of efficient market hypothesis. It was stuff that sounded good in an academic laboratory, but then when I would try and put things like that to work, I could not make it happen. And this was like 1992. And early on in my career, I was introduced to who Buffett was. Buffett had just taken a position in Coca-Cola. He was the largest shareholder in Coca-Cola, and he had just bought all of Dairy Queen. And it lined up with the predictable, consistent mindset. And the research, I was working for a big broker dealer at the time. The research that was put out by a broker dealer, a couple things. Number one, I couldn't always understand how and why they made decisions. So that made it uncomfortable for me to follow. Number two, I realized that in the broker dealer world, the big money is made on the investment banking side of the house. There have been many cases where big broker dealers have been sued because they were protecting investment banking relationships without giving true due diligence to the research that was published to have retail brokers in that same organization push one stock versus another. So the combination of me not understanding how Wall Street was coming upon their ideas was one problem I had. Number two, recognizing there were tremendous conflicts of interest with the how and the why research was being structured. They were never going to bite the hand that feeds them in terms of saying, a good example, MCI WorldCom is one of the most famous bankruptcies of all time. And Frank Quattrone was the lead analyst with Citigroup. And I mean, he was making hundreds of millions of dollars as the big analyst because WorldCom rather, was borrowing so much money from Citigroup. And so there were lots of conflicts of interest on the investment banking side. And the week that WorldCom filed for bankruptcy, Frank Quattrone issued his last buy rating. And it's not that he was a dumb guy, it's just that he was getting paid to pump the stock. And so if he wanted to continue making $100 million a year, he was not going to say anything bad about WorldCom. So understanding that, it was easier for me to follow Buffett, who was looking for these predictable compounders, predictable, consistent. The other thing, so I started in 92. I had a pretty good run until 1999. Well, in 1999, we had the tech wreck. And that is when I really figured out the value of looking for the predictable companies that you can actually do some analysis on. In 2000, we actually had positive returns as the tech market started to collapse. Remember, between 2000 and 2001, the Nasdaq fell by 80% and the S&P 500 fell more than 50%. In 2000, our clients were up about 10%. It wasn't great. The next year, in 2001, when things continued to get bad, we were down like 11%, but it wasn't anything like the 80% decline. And what we realized was that clients they didn't like what was going on, but we could at least help them to understand how and why their portfolio was structured the way it was. And it allowed them to see where they were headed. Those types of things, and especially now navigating through 2000, 2001, 2008, 2009, and the pandemic, all of that has truly reinforced our mindset of how we want to manage portfolios. Because I can sit there and say, okay, Microsoft during the pandemic, I need Microsoft more now than ever. I am not going to sell this asset. Plus, look at all the ratios. I can look real time under the hood and see how well Microsoft is performing. That allows me to be a lot more patient and wait for opportunities in severe downturns. Those types of things, especially the real hardship in markets, when you see the S&P 500 selling off by 50%, that's when you figure out how good your strategy really is. And that is what has really made us become comfortable managing our portfolios. Yeah, number one, I encourage you to use GuruFocus. Obviously, if you're on this webinar, you already have found it to be of use. I am amazed at two things. Number one, how much useful information is on GuruFocus. Number two, Charlie Tian has been incredibly gracious over the years that whenever we have suggestions to make GuruFocus better, His developers have usually been pretty consistent in listening, trying to figure out how do we improve the website. So if you have ideas, I would share those. I know he's always listened to us, number one. Number two, if you have questions for me, my email is dave@sather, Sather, financial.com. If you're on GuruFocus webinar and you've listened to me yammer on for an hour, feel free to email me if you got other questions, and I'm happy to help you. Thank you.